May 10th, 2024. Thinkorswim is migrating to Schwab, so that's why this is blue. The program's a little messed up right now. But anyways, coming into the day, the past 2 days have been some sort of, bull day. So I thought that, especially with how strong this was, and the big gap up, that it was likely that we were going to get 2 hours of sideways to down trading, starting probably by the end of the second hour, maybe 70% chance as the stack goes. So big gap up, a bull bar closing near its high on bar one. It's good for the bulls, and we're always in long from the big gap up and the follow through on bar one. So clearly always in long. And considering yesterday going into the close, we were always in long. But, we're pretty overbought. So I'd imagine we're probably going to pull back. Follow through for the bulls on bar two, but a doji bar. So it is follow through, but it's not ideal follow through. It's not what you want to be buying this high in what's probably a developing trading range. Bar three, a big tail on the top. So, we've only had three bars so far today, and they've all been bull closes, but none of them are really ideal. So I think that most likely we're probably going to end up going sideways to down soon. Even bar one, if you think about it, if you want the start of this strong bull trend from a big gap up, you probably don't want this big tail on bar one. You probably want a bar that looks more like that to show that they were buying, traders were buying the open of the bar, because what you really see here is traders were more interested in buying the pullback of the bar. I don't know, maybe from the gap. Yeah. So here you go. Right. So you got the big gap up and then this bar, closing up here, and bulls were more interested in buying around the 50% pullback. And it's not really a coincidence that, the bar closes up here and then the 50% pullback ends up being where the algorithms bought it. They bought here, essentially trying to drive the market up to this price point. So the algorithms are, much smarter than most of us, and they have the money to create, put the market essentially where they want it to be. So a lot of times you'll see things that look like hindsight, but the algorithms are making it happen in real time. Obviously, really pretty impossible to see as a person, but they're not people. Four, a tail on the top of the bar. So 4 bars on the day so far and 4 bull closes. Good for the bulls. Probably a second leg up if we do start to go down. But again, you have a doji on bar two, a big tail on bar three, and a big tail on bar four. So really not what you want to see out of a bull trend. This is more of a trading range where traders are going to look to buy a pullback rather than buy at the highs. Bar five, we trade below bar four and we find buyers below. Not that surprising. It's a bad low one short for the bears since we have 4 straight bull bars and a gap up and we're always in long. 6 is a low 2 short for the bears. So we traded below 4 on 5. We pulled back and now we have a low 2 short on 6 after the gap up, but I'm not selling below 6. It's a bull bar. We have 5 bull closes so far today. 7's a big bear bar. Usually, or a lot of times on bar 7, you have some sort of strong move. The reason for that is there's often a news report that comes out around bar 7, but I don't think that, it's not really tradable to sell below bar 6. It's not really a good idea, but just sometimes there are really, really large moves on bar 7. And bar 7, a big bear bar, but a big tail on the bottom. It probably makes the market always in short or very close to it. It's big enough that we're probably going to get a second leg sideways to down. Would I sell the close to 7? I probably would not, because we're most likely in a trading range at this point. 7 is a lower probability sell if you're selling the close, if you're looking for a big bear trend. This is one of the days where you did end up getting a bear trend, so it would have been profitable this time. But I think a lot of times 7 ends up being, you get disappointing follow through on bar 8. So it makes more sense to wait and see the follow through. And you do get somewhat disappointing follow through on bar 8 in that it was a bull bar. Do you sell below 8? I personally wouldn't, but it's a low 1 short. If you're a bear, you think this is a bear trend. Now this is a low 1 short, so some bears might sell below. But I think the more credible argument is that we're probably forming some sort of trading range. We might have to fall below the low of the day, but probably buyers somewhere below. Bar 9, a bear bar, but a big tail on the bottom. So again, we're probably always in short, but it's not as good as it could be. Probably buyers below 1, probably buyers below 9. 10, a bear bar closing near its low, but it's closing right on the moving average and has a tail on the top and the bottom. So I didn't think, I thought selling 10 was kind of difficult when you're selling that low, but there was something really interesting. The bulls, if this is a trading range, bulls should be able to buy below bar 8, scale in lower, and make money, and they were not able to. So you can see we have an open gap with the 8 low and the 10 high. I thought that was really important. We had this open gap too with the 6 low. In theory, traders should have been able to buy below 6 and scale in lower and make money, but it was less of a reasonable buy because you were buying really high in a trading range at a volatile time. I thought that the open gap with the 8 low was a lot more important than that one. So now bears, they have, an open gap and they have this big bear surprise and we're always in short and you have a bear bar closing near its low. So a lot of things going for bar 10 and it's a reasonable sell, but I thought it was just tough to take that short when it's closing right on the moving average. 11, a disappointing bar. It's a bull doji bar. So the bears, they wanted to see a big follow through bar and instead we get a bull doji, which is a reminder to traders that we're probably in a trading range. I think that most bears will exit above bar 11 um, and look to sell again lower. If you're trading always in, you probably don't have to exit below or above 11. Something I was thinking about earlier, I'm just going to go on a side tangent here. And bar here. Something I was thinking about earlier is, the concept of always in trading ranges. If you're trading always in a trading range, you can't be taking trades like buying above 56 and just getting out below 57. Trading ranges are usually, if you're going to take it, usually the always in comes close to flipping, but never quite flips. I thought we became always in long somewhere in here, and it never really clearly went always in short again. So in my opinion, if you're going to be trading always in, you're probably going to do pretty well on the trend days, but most days are trading range days. So you might struggle a little bit if you're exiting quickly and you're going to have a lot of small losses that'll add up. So instead of doing that, you have to buy and just hold through a lot of probably relatively uncomfortable pullbacks. So always in trading ranges doesn't make as much sense where, you would have to take a buy like 28, which is a possible low of the day, and probably just hold until the end of the day. We did end up testing essentially the top of the channel here, on top of this climax, but if you're making money on trend days consistently and you're struggling on trading range days, it probably has something to do with the fact that the trading range days you're trading that always in strategy where you're getting out quickly and trying to get back in, which is very profitable on trend days, but on these type of days it's more buy low, sell high, and so rather than buy high and buy more higher. So just keep in mind if you're in a trading range, it probably makes more sense to sit through disappointing pullbacks or just really, really, really only look to take the very best trades, which is probably the better strategy anyways. Bar 12, a bear bar closing somewhat near its low. You can see the traders, they knew that the rest of the bulls were going to exit above 11. So a lot of them, they just sold the close of 11, tried not to let it trigger, and that's what caused the big bear bar on bar 12. Bar 13, it's not really a very good buy, but it is some sort of parabolic wedge. I think the problem is it's a big bear micro channel, right? So you have a bear micro channel from bar 6 to bar 13. So it's like an 8 bar, or I guess 9 bar from bar 5. So it's like a 9 bar bear micro channel. So the first reversal up is going to fail. Additionally, 13 is a bear doji bar. So really unlikely to be buying above 13 and expecting anything good to happen. However, it is still a wedge. It's a parabolic wedge on a lower time frame. So you might get a deeper pullback than you would want. 14, a bull bar closing near its high, probably part of the deeper pullback than you would want. You might have to get 2 legs sideways to up because it is a parabolic wedge, but ultimately we are probably going lower. 15, a bull bar, but a big tail on the top. Disappointing follow through if you bought above 14. I don't think 14 is a very good trade at all, but if the traders who bought it are, they're either scalping out, they're taking their 2 points basically here and getting out, or they see 15 not be an amazing. I mean, if you're taking a trade like 14, your premise is that we're about to trap, all of the bears. And it's really unlikely that it's going to happen. But if it's going to happen, 15 is going to be a really good looking bull bar, probably closing somewhere up here. So when you don't get that, if you get anything less than that, traders are just going to, sell the market and just exit their trade. And that's exactly what they did on 16. And that's why it's a bear bar, because they see this, they're disappointed, they just sell, and that causes 16. And, parabolic wedge, so you expect second leg sideways to up. You might not like it, but the tail on 17 is your second leg sideways to up. It's trying to test the 15 close. It wasn't quite able to because there was a lot of downside momentum. But that does qualify as a second leg sideways to up, trying to test the 15 close. So anyone who's taking this is getting out. If you bought above 14, you should have found a way to get out with some sort of profit, because it's really not a good buy after this parabolic wedge and these 8 bear bars. But I would imagine that would be how you would manage it if you took that trade. 17, a huge bear bar closing near its low. Do you sell 17? I don't think so. It's a big wedge. We're all the way down here. I think if you're selling it, you're selling a big sell climax low in what's probably a trading range. And you're selling the bottom of a channel. You can see 7, 13, 17. So some sort of wedge channel. So I'd rather not take that trade. 18, a reversal up. It's probably a credible buy, but I was disappointed it didn't close on its high. If it had closed on its high, I probably would have taken it. hoping it was a potential low of the day. However, there was a tail on top, so I decided not to take it, which is the same reason I didn't take 28, but I thought that 28 was definitely better. And I gave 28 more consideration than I gave 18. 19, disappointment. So essentially a low one short. But I'm not taking the low one short. I think we're probably going to get a couple legs sideways to up. 20, a big outside down bar. Testing the 17 close. So anyone who sold the 17 close probably scaled in higher, maybe at a 50% pullback if the bear move, maybe above 18. Yeah, so well, we didn't quite reach it, but somewhere in that area. 21, an inside bar. It's a high one for the bulls. They want, essentially this to be the start of the bull trend, and they want to start getting good bull bars, but they need to start getting it rather quickly because this is starting to look like a trading range to me down here. And if it is, we can easily fall below 18. 22, an inside bar. Bears, I think the bulls have the better argument that 18 is the start of a couple legs sideways to up and probably a trading range. And 19 and 20 and 22 are a two-legged correction for the Bears after this, or for the bulls after this bull trend has started, or probably just trading range. 23, an inside bar. So we have an III, 21, 22, 23. When you have an III pattern, you have to be expecting a trading range. I have IIs. I actually meant to throw that in here. You can see most times III, final flag, failed breakout above, and then a trading range. III, you can see we try to get the breakout, but we got the downside breakout. So really all an III is a trading range or a triangle on a smaller time frame. 28, you can see III here and then the breakout. So, excuse me, my throat's really dry. Whenever you get a pattern like this, you know that it's a triangle on a lower time frame, and triangles are just basically breakout mode patterns. So you're expecting some sort of breakout, and 50% chance the first breakout fails. So 24, a bull bar, but a big tail on the top, basically to the top of the tight trading range that started 18, 19, 20, and 20 is the high of it. 25, a bear bar, closing your, above its midpoint. It's not a very good sell, but it is a three push pullback from the surprise on 17. So you have 16, 17, big bear surprise, and then pullback 18, 20, 23, 24. So it's three legs up after a big bear surprise, and it's at the moving average. So it's probably okay to sell 25. However, not a lot of bear trends start with bars like 25. So I think that you're selling kind of the middle of a tight trading range, and it's probably a scalp, if anything. 26, a bear bar, but a big tail on the bottom. Follow through 27, but again, a big tail on the bottom. I think the bears who are selling below 25, pretty happy with making 5 points. Probably makes more sense to just take it, scalp out somewhere in here. 28, so we have a wedge, the parabolic wedge to here, and then we have a wedge channel, 1, 2, 3, and a failed breakout below the III, which is the final flag for the bears. So a failed breakout below final flag, a wedge channel, a wedge overall. So I think a reasonable buy above 28, betting it's the low of the day. But you're not buying above 28 thinking that you're just going to get some massive rally. You're buying above 28, betting on basically a channel for the remainder of the day. So 28 is more of a Walmart trade where you buy, put a stop below here, and you do something else for a few hours and just see if you make money, pretty much. One of the targets, probably the top of this channel where we did end up reaching. And I thought the 8 low, if we got there, or around the open of the day, I thought that's what we were trying to do over here, is reach the 8 low or the open of the day, but we didn't end up doing it. 29, follow through for the bulls, but disappointing. Big tail on the top, just testing back into the middle of the tight trading range. And then a second leg up, 30. You could argue that 28 is the first leg up, 29 is a pullback, and 30 is the second leg up. So 2 legs sideways to up to the moving average, and then 31 a bear bar closing near its low. But with all the things that, the argument for the bears is it's a bear bar closing near its low at the moving average in a weak bear channel. So when you're in a bear channel, you want to be selling the reversals down from the moving average. However, the wedge is most likely going to get the second leg sideways to up. So you can see that we got the wedge here. And I thought that this was not enough of a second leg. And so better not to sell 31 and instead wait to see what happens, because this is probably going to get another leg sideways to up, at least. 32 is a high one for the bulls. If you were betting that 28 was the low of the day, I think that argument is still credible. Okay to buy above 32 for a swing. Follow through 33, but a tail. Again, you're not if you're buying above 32, your stop is at the low of the day. You can't buy above 32, stop below 32. So your stop's probably at the low of the day, and you know you're going to sit through a pullback. And it's very unlikely we're just going to rocket straight up right here. 33, disappointing follow through, relatively expected. 34, bears see a big low too, but I'm not selling. I think at this point we're probably always in long, and it's a really small bear bar, so it just looks like a trading range to me. Outside up, or not quite outside up, 35, a bull bar, but 3 legs up, 28, 32, and now 35. So better not to buy above 35 and instead to just wait. You can see sellers above and essentially outside down 36. Again, if you were taking a buy like 35, your stop is at the low of the day. Your stop is not below 35, and you can't, realistically, it doesn't make a lot of sense to buy above 35 because you're most likely going to get a chance to scale in lower. So difficult to do. 37, a bear bar after 3 legs up, yes, but a doji bar, and I think trading range. So better to wait, look to buy lower or sell higher. 38, really just not ideal follow through. If you sold below 37, you wanted a much bigger bear bar. We're probably going to get back to the 29 or the 31 low. If you were to sell below 31 and use an ultra wide stop and scale in, you're probably going to have a chance to get out because, it wasn't a good sell. It was credible in the sense that there was reasonable logic for the bears in that it was a pullback to the moving average. So the traders who are selling 31 probably have a stop somewhere up here and are scaling in above 31. And some of them, they sold, they scaled in higher, and they used this sell off to get out at break even. Others scaled in even higher, scaled in maybe above here, and you can see on 52, we reached their initial entry price, and that's why we bounced on 52. 39, an inside bar. Bulls want to break out above the wedge that we got, so 30, 33, 36, and bears are hoping this is a pullback after the wedge, so 36, 37, 38, and they want 39 to be a pullback and get another leg down. It's pretty sideways here, so I don't think either side has an amazing argument. There's a lot of problems with both sides. 40, a big bull bar closing near its high, towards the, breakout essentially of the top of this range, 18 to 20. But I think we're going to end up being more sideways up here. And you can see you get disappointing follow through 41. 41 is a high one for the bulls, but it's a high one, high in a trading range, and your follow through was not all that great. So I have a lot of trouble looking to buy above 41. Instead, you get a failed breakout above 41 and a bear bar closing near its low, 42. Incredible sell, 42. Disappointing that it did not close on its low, but I don't think it's unreasonable to sell. 43, more follow through, but a big tail. So you can see a lot of tails in the bottom here. We're probably not going that much lower. We might have to get below here because this was a buy climax, and you oftentimes get below the lows of buy climaxes in a trading range and above the highs of sell climaxes. 44, a big bear bar, does trade below that buy climax low, and then we get a doji bar 45 as follow through. Probably going to get another leg sideways to down from 41 through 44, but I can't imagine we're going all that much lower. Something rather disappointing for the bears, most likely. 46, bad follow through for the bears above, or for the bulls buying above 45, betting that this is some sort of double bottom. Obviously, it's not a good buy, but just theoretically, probably better sell above, but the pullback could be deep. So a lot of problems for everybody. 46, a low one short for the bears, but 47 is not the follow through you want. I'm not selling 47 though. I think it looks like a second leg trap. And disappointment 48, you can see 2 legs and then another leg up 49. So once you start to see these 5 bars, you should be thinking tight trading range, which is what it was. And we essentially, to 52, we got a wedge. So my problem with 52 was you're buying at pretty much the exact middle tick of this overall trading range so far, and you're buying in the middle of a tight trading range. However, the risk is small, and overall, traders were expecting a bounce from the sell-off. So it was credible to do. You probably have to scale in lower if you're going to take it, but I do think it was a credible buy above 52, looking for some sort of upside breakout. I didn't notice this real time. I was looking at Al's slides after, yesterday. And he also mentioned that it was a double bottom with 32 and a higher low major trend reversal. For me personally, I more just viewed it as a wedge. But I thought, that was probably obviously a better way to look at it. 53, follow through for the bulls, so really good follow through. And more follow through 54, but it's not a trend day, right? It's a trading range day, so probably sellers relatively soon. You can see we have these 2 lines connecting. It's some sort of wedge at some point here. 55 tells you that traders are scalping. 55 tells you what you need to know. It tells you that traders are not buying up here; they're instead using it to take profits. The buy was down here, and traders are scalping out with. I probably would say 5 points makes the most sense. We did get a little bit above that on. So 56, a bull bar closing near its high. It's an II 55, 56. So if you're buying above 56, you're buying an II, which is a final flag. So you're buying a final flag at the top of the trading range on a trading range day, and it's a third push up. So a couple legs sideways down is more likely than any sort of rally. 57, a reversal down. Probably not the worst sell below 57 if it triggers, betting on a few legs sideways down, some sort of scalp. Instead, we get a bull bar 58. A lot of the good entries don't trigger on trading range days, right? So a lot of the entries that you have to end up taking for stop orders are not as good as you want them to look with the signal bar, but the context makes sense. 58, a bull bar, but probably sellers above 57 since 56 was disappointing. And then 59, probably a reasonable sell since it was a wedge and you should be expecting two legs sideways to down, and you get disappointing follow through 60, but you do get the second leg down 61, 62. And you can see those traders were not quite able to make 5 points. So a 21 tick trap. What a 21 tick trap is when traders are trying to make 5 points. So if you're trying to make 5 points is 20 ticks, right? Every tick is every point is 4 ticks. So if you're trying to make 5 points, you're trying to make 20 ticks. But if you're selling below a bar, you have to sell 1 tick below 59, and you need the market to go 1 tick past your profit target. So it would hit your profit target exactly here, but it would have only gone 20 ticks instead of, or it would have only gone 21 ticks because you needed to go 1 tick past to fill your order. So it wasn't quite able to do that. So when traders see that, they see that 62 is getting bought up, and they start thinking, uh-oh, it hit my order but didn't fill it. I might be, this might be a 20 tick trap or a 21 tick trap. And that's why they exit, causing 63. After 2 legs sideways to down, we probably were never always in short. So probably okay to buy above 63, always in long, but I probably would not do that. Followed through 64, 65, 66. At this point in the day, I'd probably be relatively done. You can see we're approaching that channel line again. And towards the end of the day, we tried to get a breakout above it, but ultimately failed and just big sideways at the end of the day. For stop orders, I thought that, kind of a tough day, but 10 was reasonable. I wouldn't take 18 with the tail on it. 25 maybe, but it's not something I would take real time. I don't have that kind of confidence in myself, but I thought the context was okay for it. 28, I thought was okay if you're willing to just sit through a lot. 32, probably fine. Same premise as 28. 52, 53, probably fine. And then probably 59, but I wouldn't really take much other than that. For the daily chart, to me, looks like 2 legs up, 1 pullback 2. It's a pretty tight channel, so we might get 1 more leg up towards this high. I thought the high of this was relatively important, and we might have to get there. I usually look at this with extended hours on at this point. So you can see we were testing the top of this sell-off. I thought we might have to get up to here since, this was a bull bar and there were going to be traders buying above it. It's essentially a high too. So I thought we might have to get 1 tick above this. I'm not sure if we will, but, are you selling below this bar? Probably not. I think that if you're selling below this, you're willing to scale in a lot higher. This is a pretty tight channel. So ultimately, I think even if we get a little bit sideways to down, maybe back to 5,200, this is going to fail. This is not going to start a big bear trend with this tight of a bull channel. So I think it's going to fail. On the weekly chart, good for the bulls. You can see we touched this low, right? 52.63. And you can see we got 52.64. So we basically went up to this low, and then that's where we sold off. So 52.64 is where we reached up here. And that's why there were sellers there, because of the weekly chart. But on the weekly chart, again, kind of the same problem. I think that, with how big these 3 big bars were, this is going to be a minor reversal up, and we're going to start to go sideways here pretty soon. The rally, for the most part, is probably over for a little while. The monthly chart, I suppose, doesn't matter all that much yet, but this is a really big out rally really early in this bar, so I'll be interested to see how this ends up closing. A high 1 for the bulls, trying to keep the gap open. Yeah, that's the day.